Ladies and gentlemen, welcome to another episode of Making Sense, a Eurodollar University episode production. My name is Emil Kalinowski. I'm joined with Jeff Snider, Head of Global Research of Alhambra Partners. Did I get that part right, Jeff? I'm stumbling. I'm only 2 seconds into the show.
Well, I think the problem is you're recovering from yesterday where we thought, hey, this is the end of the world, and we're surprised to actually be here today. So the audience is going to have to bear with us as we get over the shock of actually being here an extra day, at least an extra day, maybe further.
Well, today is the anniversary of the publication of Dracula in 1897. I figure I'm going to be able to link that somehow to the full moon and some of the bats that I've been seeing around out here. All right, people are turning off quickly. We're going to tell them we're going to be talking about the Treasury International Capital Report, which is one of Jeff's favorites or most in-depth that's available to see what might be happening in the global Eurodollar system. And we're going to be talking about foreigners selling treasuries. That's where we're going to start off. And you hear about it often on Twitter and on various podcasts that foreigners are selling on purpose. And I was just scrolling through Twitter, and then I came across this tweet by Robin Brooks, who is the chief economist at the International Institute of Finance, former chief foreign exchange strategist at Goldman Sachs. He's talking about the same TIC report data that we're going to go over with Jeff right now. Quote, "Foreigners stopped buying Treasury securities and aren't coming back. That's true for Treasury bills and bonds and notes, and holds for flow of funds data plus TIC data that go to Q1 2021. There won't be a foreign flows conundrum like in 2004, 2006 this time." Jeff, you start out talking about foreign flows. What's the mainstream narrative?
Well, the idea is, I think, as the economist was stating, the global savings glut, right? The idea that foreigners, for whatever reasons, Ben Bernanke said it was baby boomer savings for retirement. In the pre-crisis era, they had preferred buying a whole lot of U.S. Treasury securities, not just U.S. Treasuries, but also agency debt and even some forms of MBS, mortgage bond securities as well. And then suddenly, for whatever reason, they stopped buying, or they stopped buying as many, and in certain times they've actually sold them, and that has created a whole lot of confusion as to why are foreigners suddenly selling them. Because before 2008, it seemed like they couldn't get enough. They wanted to save all of their money in safe American assets. And following 2008, it seems like they don't seem to really like these things anymore, particularly after 2013. So something about after 2008 and then after 2013, foreigners no longer really like U.S. Treasuries. And the question is why? What is going on here?
Well, what people would say is because the United States government is so spendthrift, because the people in charge have lost the confidence of the global community. And therefore, why should we subsidize this country that's out of control? And that's why they're selling. That's what.
Right. That's the emotional argument, right? That's that these damn bastards in Washington need to be punished. And I think that's what clouds a lot of analysis, is that people are waiting for some market activity that forces sanity on these people. And so they want, in some ways, they want the Treasury market to blow up. They want foreigners to say, screw you guys, we're not buying your paper anymore. But yet that's not what really happens. That's what people want to happen, because they want the government to be shunned and denied access to credit markets, so that the government has to finally is in some way boxed in so that it begins to act responsibly. But as we see in the chart that you're showing here, Emil, it's the exact opposite. When foreigners stop buying treasuries and actually sell them outright, as they have, especially again, since I said 2013, what happens to the prices of treasuries? Under that narrative, you would expect the opposite to happen. You would expect that treasury prices would go down and therefore interest rates would go way up, because we need foreigners. That's what we've been told for so many years. That's what The Economist was talking about in 2004 and 2005. Without foreigners, the treasury market is toast. It's dead. It's death. You would be crazy to own any kind of U.S. government debt. But what we see time and time again is it's the opposite case. Whenever foreigners begin to buy less and then actually sell, the prices of U.S. treasuries go up, not down. So they're inversely correlated to the way it's supposed to work, which tells us something very important about why foreigners must be selling treasuries in the first place.
You summarize it very well here in your article. When dollars are less hard to come by, reflation, foreigners tend to buy these assets back even as the rest of the marketplace seems to be selling them as growth and inflation expectations rebound. And the article that we're reading from, ladies and gentlemen, you can read it too. It's TIC, spelled T-I-C. Reflation rolling over. I'm having trouble with my words. You know why? Because I didn't have my customary traditional shot of rum before each show, and I'm missing it. Okay, it was posted on the 18th of May at Alhambra Investments, and right at the beginning you say we're going to be answering two questions. The first one is, does reflation still have legs? And the second, or are we seeing signs of a premature demise, maybe even rolling over already toward what would then be the next global dollar shortage surge? It's just going to be happening throughout the show. I cannot say words this morning. I don't know why. So the first part of the show, we're going to be talking about things that you saw in the TIC report that do suggest reflation. And what we just talked about, foreigners are not selling as much, right? I want to say buying, but they haven't quite reached the
Everything is
line.
Relative, right?
Yeah,
it's not
so they're
outright.
Tell us.
Yeah, it's rate of change. It's always rate of change. If foreigners have been selling a lot and then they start selling less treasuries, that can be reflationary. In the same way that foreigners who used to buy a ton all of a sudden buy a lot less, that can be dollar shortage. And really what we're talking about here, when foreigners buy and sell, has to do with is the Eurodollar system throwing off enough monetary resources that allow countries around the world, especially in official channels, to rebound those dollars back into the U.S. in the form of buying U.S. dollar assets, primarily U.S. Treasury notes, bonds, those types of things, and bills as well. And if the Eurodollar system is experiencing disruption, there's fewer dollars flowing throughout the rest of the world. What happens a lot of times is we see foreigners have to sell these assets to liquidate them in order to gain liquid currency deposits and things like that, so to offset the dollar shortage in the marketplace. And that's why it's inversely related, because when there's a dollar shortage and foreigners sell treasuries, that dollar shortage tight money is something that encourages global demand in these same instruments, which is why their prices go up, not down, when foreigners are selling. So it's entirely 180 degrees the opposite the way everybody says. And so what we want to see of the TIC data, if we're thinking about reflation, is, as you pointed out, Emil, foreigners are either buying or maybe they're selling less than they had. And that's really what we saw in the first quarter of 2021, which is no surprise, because everything about especially January and February was intensely reflationary.
It says here that in March, the net increase of all types of recorded U.S. dollar assets among all the various foreign holders surged by a monthly record of $208 billion. Reflation. Excellent.
Yes.
Next one, a little bit riskier specific area that we're going to look at is corporate bonds. And that also found favor. I'm going to pull up the graph. So another reflationary good news sign.
Yeah, corporate bonds had been one signal going all the way back to the late 2018, what we call the landmine, which said, hey, there's something wrong here. So foreigners had been binging on corporate bonds ever since 2015. All of a sudden in late 2018, they started to say, look, we don't want these things. And they began to sell them at a rate which had been unprecedented in the TIC series, especially when we get into 2020, which is obviously the COVID recession, everything last year. And then, of course, going back to October of last year, they started selling fewer corporate bonds and then outright buying them during the first quarter, which is a definite reflationary signal consistent with what we saw in bond markets around the world.
Another reflationary signal is the first quarterly increase in reported measured bank liabilities. According to what banks told the Treasury about their operations in Q1, total estimated U.S. dollar foreign liabilities rose by $126 billion, meaning it's U.S. banks now feeling confident, whereas before we were just talking about foreigners?
Yes. And so U.S. banks were extending more U.S. dollar liabilities to overseas counterparties. And that rate was actually a pretty substantial rate.
Okay.
But what you notice, though, that's a quarterly total. All of the bulk of that increase came in January and February. In March, it was actually a decline. And we don't want to make too much about the monthly pattern, but that's something that's consistent. We've seen time and time again. Of course, Emil, you and I talk about all the time, February 24th and 25th as a inflection point that here we are 3 months later is still visible across all of these charts. So purely reflation in treasuries and global bonds around the world, maybe just January and February, and the bank liability data says, yes, January and February, heavy reflation. March, not so much.
Jeff, I'm proud of you. You've segued from the unabashedly good reflationary data to the kind of good news, and now we're heading into this is definitely not supportive of reflation. And
it wouldn't be our style just to be unbridled optimism, right? Well, that's not our thing. Our thing is to be, objective reality, and of course, objective reality most of the time is, well, there's a few good signs, but more often than not, they're going to be quickly overwhelmed.
And one of the signs is the U.S. dollar, the broadly weighted U.S. dollar. Tell us a little bit about 2017 in Q1 and how the U.S. dollar reacted to what just happened in 2021 in Q1, which was similar in the TIC report data, but the U.S. dollar is acting anti-reflationary. I'm pulling up the chart.
Yeah, in 2017, the U.S. dollar began to drop, which, that was consistent with reflation, what we call reflation number 3. And at the very beginning of it, you see circled on the chart here, a big rebound in bank liabilities. Again, U.S. banks being more confident about offshore reflation, globally synchronized growth, whatever they called it back then. Therefore, that was consistent with a falling dollar, but not necessarily a crashing dollar or a diving dollar or any of the other things that were tossed around back at the time, because very quickly you can see that reflation in bank liabilities didn't last very long. There was a much more modest increase in Q2 and then in Q3 before getting into Q4 2017 and Q1 2018, which sort of spelled the end of reflation because it never got to be anything more than reflation. This time around, however, we got the big rebound in liabilities that was consistent with what we saw in bond markets, but yet curiously, the dollar's exchange value has been relatively stubborn. I wouldn't say it's strong, but it didn't fall any further than it had during 2020, and has been maintained in most currency crosses outside of a few of them. Even the euro, for example, has been sort of sideways ever since January. So we're not even seeing, yes, it's reflationary in this bank data, which is not, it doesn't directly translate into currency terms, but currency exchange value translations, but you would expect there'd be some more consistency there.
One of the nice things about the TIC data is that it provides you data by country, and then you can group those countries, and what you see is global money centers, the United States, Europe, the Caribbean, and for Asia, it's Japan. And we can take a look at Japanese bank liabilities. Is that right? They're borrowing from the United States, presumably to invest. But what do we see? We see that they're not as enthusiastic in the March data.
Yes, this is U.S. banks' claims on Japanese banks. And so that a claim is a loan of some sort, or some kind of liability that's been extended in favor of Japan. And Japan has been, as you just said, Emil, it's a absolutely crucial primary post-crisis, especially Asian U.S. dollar redistribution node in the entire Eurodollar system network. Now, why that is, I think it relates to China in the early crisis period, as you're showing on the chart here. I think Japanese banks thought, well, the United States and Europe are screwed. In 2010, what Mohammed El-Erian called the new normal. But China's going to be impervious to all this stuff. So China's a great place to be. We're not going to invest much in the United States. We're going to use all of our yen to swap into U.S. dollars so that we can go and lend those dollars into China. And that started to be, that seemed to be a very good proposition up until around 2012, 2013, when China began to show signs of both slowing down as the lack of recovery in the developed world started to catch up to them, as well as official recognition that was taking place. That's been, if you think back to 2013, that's when the Chinese first started talking about rebalancing, for example. And rebalancing in the internal economy is simply said, we're not going to count on our export economy for very much longer because it doesn't seem to be coming back in the way that we wanted it to in the post-crisis era. So somewhere around 2013, Japanese banks, they heard what Chinese officials were saying. They saw the slowdown across Asian emerging markets, and they said, okay, maybe we don't want to be as dollar attached to these places as we had been. And so that accounted for, I think, a good deal of what became euro dollar number three's big trouble as far as Asia and emerging markets went. They lost a lot of their dollar funding impetus through Tokyo.
And take a look at that surge. Did we ever discuss this? Maybe it's too deep into the data right now, but during the worst of the COVID, they went back into borrowing from the United States.
Yeah, and I think that was related again to China. The idea was that China was going to come out of this in far, far better. And there was also the idea that the Chinese experience with COVID had been far, night and day different from everywhere else around the world, because all we heard about in the early days, whether it's true or not, who knows, but the Chinese COVID pandemic was mild compared to everywhere else. I don't believe that, but no. That was certainly the idea. I think that was an early story that had propagated in a lot of different ways. Of course, the Chinese Communist Party behind much of it. And I wonder how much that might have influenced Japanese bank behavior, as well as the idea is, okay, if China isn't getting it bad with COVID, their economy may not be hurt as bad. And even if it is hurt as bad, maybe China is going to benefit from, the rest of the world being depressed and China not being so depressed. And then that seemed to make a lot of sense of why Japan would be coming back into this dollar redistribution business, which I think is closely linked to China during 2020, even the early parts of 2020.
But as you pointed out, it's come off the boil a little bit recently, so it's not as enthusiastic, so not in Reflation's favor. And now I'm going to read a sentence, ladies and gentlemen, that shook me to my core. Quote, underlying this Japanese anti-reflationary withdrawal, the same is taking place across the Caribbean. And then in parentheses, we'll have to ask Emil Kalinowski to stick his head out of his window and confirm. Jeff, true or false, that sentence originally read, lift his head off his hammock before I complained to you that it would make me look like a bum. I'm going to pull up the Caribbean chart now.
Yeah, it's interesting that the Caribbean had been sort of rebounding in the Eurodollar activities all the way back to 2017 and 2018, which we've talked about before, I believe, on the podcast, where we're trying to figure out, there's some statistical data quirks involved here that make it very difficult, and some discontinuities in the data that maybe that's not what was really going on. But what we do know is that from March 2020 forward, all of a sudden, whatever was going on with Caribbean banks before 2020, after March 2020, which of course was GFC2 and the major crisis and the recession, Caribbean banks have said, well, maybe we don't want to do this dollar stuff anymore either. And if you've got Japanese banks rethinking things and actually cutting back in their dollar redistribution, and you've got Caribbean banks doing some of the same thing, especially going back to December, where that seemed to have accelerated in both the Caribbean and Japan, it really starts, okay, maybe that's why the dollar's exchange value has been so stubborn, despite reflation and evident in all these other places, is that underlying all of that, there are these signals and signs that say, something else is going on. Maybe this thing has run its course and it's already starting to erode. And ironically, or not really ironically, but very straightforwardly, it's the same way it happened in 2018, switching from Reflation 3 to Eurodollar number 3, or Eurodollar number 4, excuse me. The same thing had happened. The Japanese had heard from the Chinese and their Chinese contacts that, look, this globally synchronized growth stuff, we're not buying it. We're getting out of this. Xi Jinping, the 19th Party Congress at the end of 2017 in October of that year, where they said quality growth rather than quantity growth. And all of a sudden, right at the end of 2017 and into 2018, it was Japan leading the retreat that kicked off what became Eurodollar number 4. So we see the same thing happen in 2021 in the same TIC data. It doesn't prove, it doesn't suggest, I mean, it's not completely indicative, it's not 100% guaranteed, but it's something you have to keep in mind, especially given how things have unfolded. As we've said time and time again recently, everything had seemingly gone right during that period, January and February especially. You got vaccines, end of the pandemic, massive stimulus all over the world, QE, if you believe in that sort of thing. I mean, everything was supposed to be going right. An end to the pandemic was in sight, all of these things, and yet here's Japan, here's the Caribbean cutting back, very deflationary stuff. And maybe that starts to account for why we're seeing all of the contradictory stuff in global markets, despite the fact that, and as you point out, why is this reflation so much less than all these other ones? And it may be because it's already being undercut even as we get into it.
So we've been looking at it from the foreigner's perspective. They are borrowing from US banks because they have enthusiasm for the rest of the world. Although now, as we've been talking about, it's not as much. Perhaps that goes against reflation. Now we're going to flip the perspective. We're going to be looking at US banks, and they're borrowing from foreigners. And what are they borrowing? They're borrowing short-term Treasury securities. That is unsettling, Jeff. Let me pull up this graph, and you tell us if I'm right in thinking that this is somewhat troubling. Short-term U.S. Treasury securities.
Yeah, and I'm glad you brought that perspective because I want to explain that too. What we see in the blue data, as I call it, the blue charts, that's U.S. banks and what they're doing with respect to the dollars flowing outside the U.S. And then there's this red data, which are U.S. bank liabilities to foreigners, which is what U.S. banks are doing, borrowing from foreigners. And so what really happens in this global monetary system is you have foreign banks borrowing from U.S. banks, you have U.S. banks borrowing from foreign banks, and you also have, which is not included in any of this data, foreign banks borrowing from foreign banks. So you have all this cross-border stuff, plus you have an element of shadow stuff that goes on that we have no idea what's really taking place in those kinds of things, which is why we're trying to piece all of these things together as if we're flying blind, because in many respects we are. And that's why we're trying to match all of this TIC data, which only shows two parts of the system, with real-time market data to give us a sense of, okay, are we really seeing what we think we're seeing here, with only really half of the picture filled in? Because U.S. banks, what they do borrowing from or lending to foreigners, really maybe not even half of the Eurodollar system. Most of it is foreigners borrowing with foreigners. And so we're kind of using the TIC data as a proxy for what might be going on in that shadow area where we have no data at all. We kind of reasonably believe that if U.S. banks are borrowing more from foreigners, or foreigners are borrowing more from U.S. banks, that probably the same thing is going on in that hidden foreign to foreign part of it.
Let me pull up what the U.S. borrowing from foreigners. Which
the red stuff.
Normally, if you told me that the U.S. is borrowing more from foreigners, good. But they're borrowing short-term securities. And
you think if they're borrowing cash or deposits or some kind of monetary quasi money or whatever, but they're borrowing short-term Treasury securities, which of course we talk about all the time, Treasury bills, and you can actually match up that short-term borrowing and Treasury securities with what are called resales, and resales are the other side of repo. If a repurchase agreement is a short-term collateralized loan, from the borrower's perspective, a resale is a short-term collateralized loan from the lender's perspective. And so in one sense, U.S. banks are borrowing collateral from outside the United States, Treasury bills. They're borrowing Treasury bills from outside the United States. Furthermore, they're not borrowing Treasury bills from foreign central banks, where you might think, well, if there's a lot of Treasury bills outside the U.S., it's probably because central banks have them. No, they're borrowing them from what TIC calls other foreign, which is probably non-banks like money market funds and things like that. So again, you get an idea of this is a global system. U.S. banks are borrowing U.S. government Treasury bills from outside the U.S. foreign money market funds and non-banks and things like that. This is a very complicated process. But what gets our attention, obviously, is that you don't see this spike in Treasury bill borrowing except in the most extreme cases where there's a collateral shortage. And of course, that was last year. But what gets our attention nowadays, sorry, Emil, just to finish the thought, what gets our attention now is that level of borrowing Treasury bills has, like the post-crisis era, remained relatively high throughout. Here we are up to March of 2021 data here. So for an entire year, we've got U.S. banks borrowing Treasury bills at an enormously high rate, which doesn't correspond to Treasury market issuance. You might say, well, hey, the government sold a lot of Treasury bills last year. That's all it is. Foreigners buying them and U.S. banks borrowing. But the Treasury auctions have been scaled back, which is, again, one of the big problems we've been talking about for the last couple of months.
My only final thought, and then Jeff, you tell us if you have anything that you wanted to share with the audience that we didn't cover, is that we see on this graph two half-dome-like cliff faces in the data, and that is the two global financial crises. But in between, we had two massive regional crises. And I think that next time you do this chart, I think you can circle the third one down below there. It's not as big, but I think you can see right there in that 2016 period,
yep,
which was a shock. I mean, 2016, in the early part of 2016, was difficult. And I see that, at least for the short-term Treasury securities held by other foreign, we have a little bit of a cliff face rise there.
And you also have it a couple years later in early 2018.
Mm-hmm.
So, I mean, this rise in Treasury bills does correspond with Treasury bill borrowing. And again, I think that's an important part, too. This is not U.S. banks buying Treasury. They're borrowing Treasury bills. Again, securities lending, collateral, all this really weird stuff that actually goes on that you don't hear about in the textbook. Or as the FOMC just admitted last week, that we have the occasion of Treasury repo problems spilling over despite abundant reserves. Because here we have concrete evidence, even though it was gathered accidentally by the Treasury Department and they don't know what they're looking at. It tells us that this stuff goes on, and it tends to go on at elevated levels during periods where we need to be really concerned. Deflationary, tight money, tight collateral, those kinds of things, regardless of the level of bank reserves.
Well, let's move to China in the next part of our discussion and see what's happening with both their economic data as well as the monetary data that we can track from the People's Bank of China, and see how the monetary and economic data are relating to each other, and whether or not China is telling us something about the future of the global economy.